how do you store money for 50 years, right? And the metaphor I give you as an aeronautical engineer, which I think Elon would like, and I think you'll like, is it's the difference between you launch something and it goes ballistic and comes back to Earth.
Suborbital versus orbital.
And you launch it and it reaches escape velocity and it goes orbital. One is in space forever, and the other's in space for a blink of an eye. And what we're trying to do is put energy in cyberspace, or put money in cyberspace, reach escape velocity such that it lasts forever with zero friction. It's like superconducting.
In today's video, we're featuring Michael Saylor, the co-founder, former CEO, and current executive chairman of MicroStrategy. This company is renowned for its provision of business intelligence, mobile software, and cloud-based services. Notably, MicroStrategy stands as the world's largest publicly traded corporate holder of Bitcoin, possessing a staggering 24,246 BTC. Michael will share his insights on why Bitcoin is destined for success, how to effectively invest in it, and what the future holds for cryptocurrencies. Let's dive right into the video without further delay.
You know, I think 2020 to 2024 was, high volatility, high uncertainty. It's like that early stage of institutional adoption, but really, we start mainstream institutional adoption, I would date it to January 2024 with the approval of the ETFs, the spot ETFs. And I think it runs, we have about a 10-year gold rush. It runs to 2034 November. Between 2024 and 2034, we will have mined 99% of all the Bitcoin. So Bitcoin becomes, for all practical purposes, fixed by November of 2024. The last 1% comes out over 100 years. Okay, so we have this 42-quarter period where at the beginning of the period...
What percentage are we at now?
Right now, we're like 94%.
Wow.
So you think it's not much, but I mean, 5% is a lot over 10 years compared to 1% over 100 years. So there's actually still Bitcoin available for sale right now. The miners have to sell it. So at the beginning of this period in Q1, we're in Q1 now. If you go to January 1st, no institution could buy it even if they wanted to. It just wasn't on their radar. And so you really have 42 quarters of people learning what it is, studying it. It takes 10 hours to scratch the surface, and it takes 100 hours before you get a degree of comfort. Most people, once they get past the age of 40, they don't want to spend 100 hours learning a new thing. It's very rare. So you've got Wall Street firms spinning up massive education apparatus. You've got a whole set of stages of adoption. First, can I buy it? Then is it on the approved list for solicited sale? Then it is on the approved list for unsolicited sale. Is it marginable? Can I borrow against it? Is it optionable? Can I hedge it? Is it recommended? Is it structural? Is it built into a fund? That's like 7 layers of adoption. People take a year to think about each of those layers. There's 100 powerful entities that control huge amounts of money that'll go through that in the Western world. So I think we're in this institutional education stage. And in 2034, it'll simply be the new thing. Right now, it's like the scary, exotic thing for most people.
As the world buzzes with anticipation over the upcoming Bitcoin halving and its potential impact on Bitcoin's price, it's crucial to pause and consider what this event truly means. For the majority of people, the halving is essentially a non-event. At its heart, the halving is a straightforward adjustment to the compensation received by those who process Bitcoin transactions. Similar to how all electronic payments, whether through credit cards, Venmo, or a simple tap of your phone, undergo some form of processing. Bitcoin transactions are no different. They are validated and logged on the blockchain by a vast network of miners. These miners are rewarded in 2 ways: a block reward provided by the Bitcoin network and a transaction fee paid in Bitcoin by the transaction initiator. The upcoming halving will cut the block reward in half, a move that, while significant, is a planned part of Bitcoin's design to control the issuance of new coins in a predictable fashion until the cap of 21 million Bitcoins is reached, likely in the next century. The reduction of the block reward is expected to have a pronounced effect on the other form of miners' income, transaction fees. This increase in fees serves as a stark reminder of Bitcoin's intentionally limited supply. Once the limit of 21 million Bitcoins has been reached through block rewards, no additional Bitcoins can be created or added to the supply, unlike fiat currencies, which governments can print more of at will. This inherent scarcity is a reason why some liken Bitcoin to digital gold. However, there are critical differences to note. Bitcoin's supply is capped at a known quantity of 21 million, while the total supply of gold on Earth is finite, but not precisely known. New reserves could be discovered at any time. Now, let's dive into the video without further delay.
The profound idea is every company in the world has toxic assets on its balance sheet. They're all liabilities, right? And we've taught the conventional wisdom in corporate finance is if you have capital, give it back and dividend it out. Facebook is buying back 50 billion of their stock and dividending out billions of their stock. Apple is buying back their stock and dividending out their stock. Scratch your head and think about this a second. I'm going to apply this to Harvard and MIT. Give back the endowment and just raise the cost of the tuition 20% a year and stack twice as many students per class, and that's how you fix the university. Right? No, right? How about this as an idea for your family? I want you to take all the money your family has, I want you to give it away to charity, and I just want you to tell your wife, your husband, your kids just to work harder and ask for a 15% raise next year. And that's how you're gonna fix your family. I said, they're both pretty silly, right? And like, you would never in a million years have that as your strategy. We give up all the capital, we work harder. But you know what the corporate playbook is? Give up all the capital, raise your prices, work harder, grow your cash flows by 15% a year, and then you'll be fine. And you know, that's why 99% of the companies fail. That's why the life expectancy of a corporation is 10 years. And you know what? I mean, Harvard, Oxford, Yale, they lasted more than 10 years. Did they do it by raising their prices 10% a year and working harder? No. In fact, there's not much productivity boost in any of those places in 500 years. So here's the profound idea, which is, you know, if we adopted a different financial model in corporations, you could have companies last for hundreds of years. You don't have to die, right? For example, you're a dentist. You know, why do I have to raise my prices 10 or 20% a year to be viewed as successful as a dentist, right? It's like, it's because, I'll tell you why, because we keep expanding the currency supply by 10%, which means the price of everything you want to buy goes up by 10%, which means you have to grow your cash flows by 10%. And that's why the Magnificent Seven generate all the returns in the S&P 500, and there are 493 companies that return nothing. Zero.
As Bitcoin's value increases, its capability for infinite divisibility becomes more significant, allowing people to transact in smaller subdivisions of value. For instance, a single Bitcoin comprises 100 million Satoshis, highlighting its potential for microtransactions. Unlike physical gold, which cannot be subdivided indefinitely, Bitcoin's digital nature allows it to mimic this divisibility, making it an increasingly attractive asset as its value rises. This divisibility reminds us of Bitcoin's finite supply and growing demand, which in turn drives its long-term price increase. As Bitcoin becomes more valuable, its usage is likely to expand, perpetuating this cycle of appreciation. In the near term, one of the most significant impacts of Bitcoin's halving event is the shift towards processors offering lower transaction fees. Here, the Lightning Network comes into play, acting as a second layer that facilitates Bitcoin transactions off the main blockchain. This network enables almost instantaneous peer-to-peer Bitcoin transactions at a fraction of the cost, just a few cents for a transaction. This affordability and speed make the Lightning Network an ideal solution for small transfers or purchases, potentially becoming the preferred method for everyday transactions. Its ease of use could also hasten broader consumer adoption. If you found this video informative, please give it a thumbs up and subscribe for more updates. Thank you for watching.